Just very good. Happy Tuesday, everybody. Thanks for joining our biweekly KW Commercial SoCal meeting. Would love to hear today's news updates, recent insight from our lender specialist friend, Lee Kleinman. Lee is also the Senior VP of BFC Business Finance Capital, based out of Sherman Oaks, right, or Los Angeles overall. Lee, how have you been?
Very good. I hope you're well, and pleasure to be here again. I appreciate the invitation.
Yeah, of course. And I must, share that the last few months, you been a great resource, and I know that a few people been referred to you, right, by our commercial group, and you do an excellent job. So thank you for supporting the agents.
Thank you for the partnership. It's my pleasure.
Yeah. So the screen is yours. Share whatever you feel like sharing with us today. Appreciate that. Great.
Okay, so just a few words and then I'll open up my screen. And thanks again for the invitation and continued partnership. It's a pleasure to be a value resource to the team in using my knowledge and experience or expertise to help your clients and transactions. So again, that's greatly appreciated. My name is Lee Kleinman, and I'm a specialty lender within the SBA 504 program. I've been in the banking and lending industry for about 33 years now. 23 years has been financing commercial real estate. And then I started my career in retail banking. So 10 years retail banking, 23 years commercial real estate finance. 30 of those 33 years was at Wells Fargo. I left about 3 years ago, and I've been at the CDC for the past 3 years. And for those of you that don't know what the CDC terminology means in lending and not health, the structure of the 504 program is as follows. A bank or a non-bank lender provides 50% of the purchase price in the form of a first mortgage. And then I come in as a direct lender for the SBA with a 40% SBA second mortgage. We're not government employees, but we're licensed by the government to do what we do and act as the intermediary between you and the customer and the SBA Loan Center in Sacramento. There's about 200 of our companies nationally to help the 504 customers in all 50 states. And the government has labeled us as a CDC, or Certified Development Corporation. So you'll hear that term, in dealing with a 504 loan structure. You have the bank first mortgage lender, and then many times people refer to me as the SBA or CDC second mortgage lender. So having said that, I will try and use the share screen, which I always have a glitch no matter how many years I've been using Zoom. Let's see if this works now. So we're good?
Yep.
All right. So this chart right here will just kind of highlight the structure that I just discussed. We have the bank first mortgage lender at 50%, the SBA, which is me, at 40%. There are some situations where this structure will change. So instead of 50, 40, 10, it could be 50, 35, 15. So why would it be an extra 5% down? Well, the customer could be buying what's called the special purpose or single use type property, like a hotel or hospitality. The government requires an extra 5% injection for those types of properties. If a client is buying a hotel, that's going to be another 5% down because that customer has owned the business less than 2 years. So in that situation, you would have a 50, 30, 20 structure. So just a couple examples as to how that typical 50, 40, 10 structure could change. Now, the second mortgage piece that I and my company provide to your customers and the marketplace, everybody nationally gets the same rates, fees, terms, conditions, regardless if they're a top tier customer, middle tier customer, or weaker customer. If you qualify for the program, everybody gets the same rates, fees, terms, conditions for this second mortgage piece that I do. Where the client has to pay attention is to the bank or non-bank 50% first mortgage. The terms, conditions, rates, and fees will vary greatly from bank to bank to bank. And this is where I feel I add the most value, because I came from the bank. I competed against all the banks when I was at Wells Fargo, so I knew who was doing what back then. And I especially know who's doing what today, because as an SBA 504 second mortgage lender, I partner with all the banks that participate in the program. So therefore, I'm seeing what bank offers what on a daily or weekly basis, pretty much, based on my current pipeline and deal flow and partnering with all the different banks. So where I'm
Holding
going.
the questions for later then, right?
Pardon?
Are we holding the questions for later?
No, I will call this a discussion versus a presentation. So during discussions, there's open conversation. So feel free, Monty.
So you said something about the customer has to own the business for 2 years. So if you're buying something new, then that doesn't apply then, right?
Well, they don't have to own the business for 2 years, but if they have owned the business for less than 2 years or are buying a business for the first time and they've obviously owned it less than 2 years, that requires an additional 5% down payment.
I see.
So it's almost like a little penalty for not owning the business for 2 years or more. It's a more riskier transaction in the SBA's eyes, so they want more down payment.
So if we come to you for an existing business, we can get away with 10% down payment. But if we come to you to buy a new business, it'll be extra 5%, 15% down payment.
Yeah. Now, keep in mind, the lending program and structure that I'm referring to is to acquire commercial real estate. So yes. I don't do the 7(a) business loans, to buy a business or for working capital. We're really just talking about a 504 commercial real estate loan. And if the business owner has owned the existing business for less than 2 years, or is buying a business and the property, and therefore he obviously has owned the business less than 2 years because he's buying it, then you have to come up with an extra 5% down payment. Does that make sense?
Yeah, no, that makes sense. I think there were some other examples. We have to just think of some scenarios. So I'll just hold off on that.
Sure. There's always that initial phone call where we just talk through all the talking points and kind of hash that out early in the process. But that kind of highlights to your question why you would have to put an extra 5% down. I've done a lot of transactions where they were buying a business and the building, and those are definitely doable, but they probably will require that extra 5% down. So anything else on that, kindly let me know. I'll be happy to address that for you. So this is where I add the most value, in my opinion, because I've lumped the first mortgage lenders into 3 categories: top tier, middle tier, and lower tier. Your top tier banks are like the Unions and the Chases, the Bank of the West, and then it just goes down from there. So you could have a client that's a top tier customer, but let's just say you met a nice business banker at a mixer a month ago, and you know and like and trust that person, and you want to refer your client to that banker. Well, your banker might be a top tier bank, but the customer is a middle or lower tier qualifying type customer. So theoretically, you could be sending a client to a bank that can't approve that client because the top tier banks only take on the top tier customers. And your customer might be a middle or lower tier customer, and you might get discouraged because the bank said no. And I think that's what happens. It's human nature that when you are turned down, or when the client's turned down, one or more involved parties might think it's not a doable transaction. Those top tier banks are declining SBA eligible transactions. Just because it doesn't fit their criteria doesn't mean it's not SBA eligible. So when I size up a pre-approval request, the financials, tax returns, business debt schedule, all that typical basic stuff, I size up the deal per se, and then based on the cash flow ratios, liquidity, business revenue trends, what have you, I can then make meaningful recommendations to bank first mortgage lenders that I think that will get the deal done. So you could have a client go to B of A, Wells, Chase, and get turned down 3 times, and you and the client might think it's not doable. But in reality, there probably is a home for it with a middle or lower tier lender that I can place that client at that right lender from day one, instead of you and the client trying to quote unquote bark up the wrong trees for a week or 2 or 3. And then sometimes when there's 2 or 3 declines along the way, either the client will get discouraged and cancel their buying motivational process, or their escrow if they're in escrow, or they might have to hire an independent loan broker and pay that loan broker fees. Where all along, if I got introduced to that client early in the process, I could have steered that customer to the right lender from day one, saving a lot of time and possible discouragement. Obviously, the lower you go in the first mortgage tier structure, the rates and fees go up. A lower tier lender is going to have a higher rate and fee than a top tier lender like Chase, but it's still probably better than renting. And they're going to be able to have all the write-offs, and they're going to build principal from every payment. There's probably going to be appreciation. They're locking in their occupancy space. They're locking in their occupancy cost. So it's still probably better to own and pay the higher rate and fee with a lower tier lender than to walk away from the transaction. So the main point that I'm trying to make is that banks decline SBA eligible transactions every second of every day nationally because it doesn't fit that particular one bank credit policy, but there's probably other homes for that loan that I could find from early in the process. Any questions on that topic? I'd be happy to answer, and then if not, we can move on a little bit.
No, that makes perfect sense, because unless a bank agrees to do that first part, you guys will not do the second part. So it's better to get your help to get some bank to agree with the first part so you can do the second part, right?
Correct.
Are there any limitations in what we can buy? Like, what can we do? Can we do multifamily units and all that with this, or are there some limitations?
So I wish, but the SBA is here to help small business owners grow and prosper, not real estate investors. So the gist of this program is to help a small business owner that's going to occupy 51% or more of the property. And I don't say building, but I'm going to get into that later, but 51% of the property. So it's not eligible for investment transactions such as multifamily. Now you could buy a multi-unit industrial, multi-unit retail, and as long as the buyer's business is going to occupy enough units to equal 51% of the property, then that's eligible, because the government allows you to lease up to 49% of the property to third-party tenants.
And that could be the land instead of just the building, right?
Pardon?
That could also be the land instead of the building to get that 51%. It doesn't have to be necessarily be just the building. It could be you lease the land. Let's say you have a unit that has land and building both, and you lease the land to get to 51%.
That is correct. So I guess since we're on that topic, let's address it now. So this bottom paragraph here, and I'm going to send these to Kim and Meny, and they can forward to the team. For businesses that require exterior lot and land space, let's just say a contractor, they have to store large pieces of marble or large pieces of piping or trucks and machinery and equipment. For business models that do in fact require outside storage space, that storage, that exterior excess lot and land space counts towards the 51% owner occupancy requirement. So I'll give you an example. I financed a parcel last year for a plumbing contractor. He bought a parcel. The sole structure was leased to a third-party tenant for years. I think many people in the marketplace would think that's an ineligible transaction because the buyer can't occupy 51% of the structure. And in all honesty, when I was at Wells Fargo, that's what I thought as well, because I never was taught this rule that's allowed by the SBA when I was at Wells Fargo. So I don't know whose fault that is, but I'm glad I know now. So this plumbing contractor, oh, and parking space does not count. So net of the parking space, there was about 8,000 square feet of excess exterior lot and land space. Some was paved, some might have been grass, what have you. The structure was 6,000 square feet. Because the 8,000 is well over 51% of the combined 8 and 6, that was an SBA eligible transaction with that buyer not occupying 1 square footage of the property. So the combined is 14,000 feet, 8,000 excess lot and land space, not counting the parking. And then the structure was 6,000. So that's 14,000 total. The buyer was occupying 8,000. You divide that by 14, which is the sum of the structure and the excess land. And that's 57.14%, well over the 51 required. So that was an SBA eligible transaction that closed escrow last year. Now, you could call a business banker about this transaction. And like me, when I was a first mortgage business banker lender at Wells Fargo, that banker could say, this is not an eligible transaction because the banker doesn't know about this SBA credit policy rule. And I'm sure I turned down many of those when I was at Wells Fargo because I never knew about this. So this is another reiteration of why there's so much value in looping in someone like myself from day one to help you properly evaluate the request, verify that it is SBA eligible, and then as a complimentary service to your client, even though I'm not a loan broker, but because I know the first mortgage landscape very well, having been in the industry for decades, I can then go find a first mortgage lender that will be suitable for your customer. And again, you run the risk of calling a bank directly and being turned down for various reasons, because either the banker isn't as well versed as I am now with SBA lending and knowing what's doable and what's not doable, or the request might not fit that bank's credit policy. And when they turn you down or your customer down, they might not be saying, well, we're turning this down because it doesn't meet the bank criteria, or we're turning this down because it doesn't meet the SBA criteria. Well, if it doesn't meet the SBA criteria, then it's not going to be eligible no matter where you go. So that's a dead deal. But the banker might not articulate why they're turning it down, whether it's not bank eligible or not SBA eligible. And that's very important, as you can see, that things can get done that the banker might not know about had you not reached out to someone like myself first. So I'm glad you brought that up, Meny. I was going to get to it, but it's an important point. I'm glad we tackled it early. Any other questions on that topic by any chance?
No, that's great. Thank you so much.
Okay, my pleasure. Anybody else on that topic? All right. So let's go back to this general 504 flyer page. The second mortgage portion that I do has lending limits. For non-manufacturers, they get $5 million per property. Now or they get a borrowing tranche of $5 million. That $5 million can be used up by 3 or 4 or 5 properties or one large property. If you're a manufacturer, you get a $5.5 million borrowing tranche for the second mortgage. And I know first mortgage lenders that will go as high as 65% for larger projects. So with a lender that goes up to 65% instead of 50 on the first, and with the SBA $5 or $5.5 million second, you can buy a building for about 21 million with just 10% down. So that's a pretty big building size for most of our small business customers. I don't have too many clients in the small business lending arena that are buying over and above that for 51% owner occupancy. So as you can see, there's a lot of borrowing power within the program. And for clients that max out their first borrowing tranche of 5 or 5.5 million, and whether they max that out on one large building or 2 or 3 or 4 smaller buildings, there's the green program, which is down here on the bottom left. The green program allows you to get 3 more $5.5 million borrowing tranches if you perform an energy analysis study on the property. And more often than not, those vendors are going to recommend solar panels. And by installing solar panels, you can cut the energy consumption by 10%. And in addition to this first borrowing tranche up here, once that's maxed out, you can go green and get $16.5 million more of second mortgage debt. So now you're over $20 million of second mortgage debt, which is like $50 or $60 million worth of properties, which none of our small business customers are ever going to blow through or go through. So there's plenty of borrowing power through the SBA 504 program. In 23 years of financing business owners, I've never seen a small business owner go through that much SBA borrowing power. So that's the good news, that they can accommodate multiple building purchases up to, $20+ million just on the second mortgage piece. Let's see. So acquisition, we talked about purchase. The 504 now does refinances as well. And effective June 29th of last year, the program, yes, effective June 29th of last year, you can now use an SBA loan to refinance an existing SBA loan. And that just became effective about 13, 14 months ago. And we are doing a lot of those right now. So that's available. On the refinancing commercial real estate, you can take cash out with an SBA 504 refi. The money has to be used to pay off line of credit debt or business expenses like payroll, inventory, stuff like that. The cash out amount cannot exceed 20% of the appraised value. So you can do a refi with cash out. We can finance TIs or renovations. I would say about half my projects include financed tenant improvements. You're buying a building for $1 million, you want to spend $200,000 for improvements. Now you have a $1.2 million project. For clients that want to finance tenant improvements, we need to get the contractor bid and the any applicable floor plan drawings early in the process, so we can give those items to the appraiser, and the appraiser has to come up with an as-is value and an as-completed value. But just know that we can definitely finance, whether you want to call it renovations, expansion, tenant improvements, remodeling, we can definitely roll that into the total project cost. The 504 also finances equipment. Believe it or not, we can go up to 25 years if it's large fixed asset type of equipment. A Heidelberg printing press might get a 25-year term. A truck might get a 10-year term. So it just depends on what they're buying. But if you have a manufacturer that's buying a larger building and they need to stock it with more equipment, we can finance equipment through the 504 program as well. We also do land acquisition with ground up construction. Not too much raw land in Southern California, but to give you an example, at the Camarillo outlets, I am doing a ground up construction project for like the 7th or 8th location for Finney's Craft House. The construction's over halfway done. They bought the land, we're financing the construction, and when all is said and done, they're going to get reimbursed for their land purchase. And at the end of the day, they're going to be at 10% down for a restaurant ground up construction project, because restaurants are not special purpose in the eyes of the government. So keep that in mind as well. And any questions on any of that, please jump in, let me know. And then going back to this Word document, a couple other things worth mentioning. Doesn't happen too often. I think I see it maybe once a year, maybe twice, maybe zero. Very infrequent. But once in a while, we'll get a below sales price appraised value. In that case, the government does not require additional injection up to a 10% value shortfall. So if you're buying a building for $1 million and the appraised value is only 900, you can still get your 90% financing on the $1 million value. So this would come into play if the seller doesn't want to reduce the price and the buyer still wants to buy the building at the sales price, which is obviously going to be above appraised value. But some business owners know that there's not a lot of inventory out there. They've probably been looking for 6 or 12 months and they don't care about overpaying for a site. They just want to move and get in. Now, not every first mortgage lender follows this policy, because when you do a 50-40-10 structure, 90% financing on $1 million purchase, but the appraised value is only 900, everybody's over 90% LTV. And not every bank wants to do that. So that's where I come into play, is I'm able to find the first mortgage lenders that follow this SBA policy. So having said all of that, I will open it up to any questions. And if there's any follow-ups, you can always reach out to me after the meeting. The last thing I do want to mention, and then I'll be complete here, is SBA is a very high-level term. There's a lot of different programs that fall under SBA. There's SBA 7A lending programs, which does real estate. There's SBA 504 that does real estate. So you might hear from your customer that you're showing buildings for, yeah, I'm talking to my SBA lender, I'm working through the pre-approval, and you might think all this good. They're talking to an SBA lender, they're going to get a 10% down loan. But there's a couple things that you could chime in about to come across as a more value-added partner to them or resource. You might want to say, oh, are you talking to an SBA 7A lender or an SBA 504 lender? Because there's great differences between the two programs. The 7A has higher rates, higher fees, requires more down payment if you're not going to pledge additional collateral. The 504 is 10% down most of the time, lower rates, lower fees. And if they say, I'm talking to a 504 loan officer, then you want to really talk to someone like me to find out that they're talking to the right lender for the first mortgage. Are they a lower tier customer talking to a top tier lender? So just because they're talking to an SBA lender, that's not the end of the game. There's probably a few probing questions to make sure they're getting the right SBA product based on their project and financial profile. So I'm good on my end. I think I've covered what I would like. If there's any questions, I'm happy to answer. And thanks again for the time, Meny, and the partnership.
A quick question for you, Lee. Good stuff, by the way, really eye-opening, and it's another avenue of the lending side that most people are not aware. Do you see, I guess, if you can want to break it down by quarters or year to date, increase of demand for, or increase of SBA loans of such nature?
Yeah, I think prior to the rate increases that caused a little bit of a slowdown earlier this year, the SBA program has never been as busy during the past 2 years. Last September, okay, the government fiscal year end is September 30th. Around September 7th of last year, the program exhausted all of the congressionally approved budget allocation. So for 3 weeks of last September, the loan center could not approve new requests because of such high demand in the program. When October 1st came around, 3 weeks later, that's when they were starting to reapprove the request. So prior to the rate increase earlier this year, the last year or two has seen the highest SBA lending demand in the program's history. Obviously, rates drive a lot of factors and activities and behavior. Earlier this year, we all know rates went up from 3% in my world to 5%. I think during the summer that caused a little slowdown. I'm seeing activities pick up again right now. So does that kind of shed a little insight? You know, things were insanely busy last 2 years, little slowdown this year. I think we're seeing the activities pick up again right now. And just a little trivia here. September of 2020, because the SBA rates on my second mortgage come out once a month. And September of 2020, that was the lowest rate in the program's history. And we're all sitting down right now, right? So it was 2.21% fixed for 25 years on commercial. So things are a little different now. Now we're at 4.97. But still, you know, you're in the 4s. That sounds pretty good to me still, compared to historical.
Thanks, Lee.
Sure.
Other questions, guys? Questions or anything you want to share? Michael?
Hey, Lee, I'm watching. I currently have the 10-year treasury open on my computer. And I think we could both agree that I'm shitting bricks and watching how volatile this thing is. And it opened at, I think today it opened at 3.22 and now it's at 3.347 just in one day. And you're like, oh my God, what the fuck's gonna happen right now?
It's a lot of volatility,
you know,
yeah.
Oh my God. And it's scary. I'm not even gonna lie. Like, we're walking into some scary ass shit, you know, in the next few weeks, you know, especially during the next Fed announcement. We saw what happened over in the Jackson Hole thing the minute he came out. And it's like everything is dependent on it. And it's just, I'm watching this 10-year treasury and I'm having these discussions and, you know, it's alarming straight up. But I do think that we will see an uptick in development in the next, you know, few months, just because long-term financing, especially if you're on a variable, is, you know, I think what's going to happen here, instead of acquisitions, they're going to move into developments just because it's structured different, and pray to God that everything normalizes in the next 2 years and then go for, like, you know, normal kind of debt. But it's a little different than the SBA kind of lending, but based on the existing multifamily world that I'm seeing, a lot of people are watching this 10-year treasury very carefully right now.
Yeah, I think there's more impact on these higher rates on the investment arena versus the owner user arena, right?
Mm-hmm. Mm-hmm.
Just the deal metrics could fall apart with a higher rate. You know, you got the NOI ratios and the cap rates and this and that. There's just a lot of analysis with every metric within a purchase structure. Whereas on the owner user side that I do, if a business is getting kicked out, if a business needs more space, if a business is tired of paying a landlord, they're still going to buy, even though the rate is 2 points higher today than it was yesterday. As long as their business cash flow supports the higher payment. Because on the owner user side, there's none of those investor metrics. We don't look at cap rates. We don't look at NOI ratios and all that stuff. It's just more easy peasy, you know?
Yeah. Look, hey, you tell me the day that you can figure out a day that I can go and buy existing multifamily with SBA debt. I'll be your best customer, I promise.
you and everybody else.
You know,
So
it's
I don't know. I mean, maybe there should be more focus on the owner user space now because the deal metrics are easier to work around with the higher rate. I don't know. I'm just thinking out loud, you know.
listen, you can always just say that each apartment building I buy, you know, I'm occupying a unit or something like that. We could find some kind of creative way.
Yeah, that's gonna take some effort. Yeah.
It could be interesting to have
Oh man.
Lee. It could be interesting to have Michael Cochette as your underwriter.
Listen, you know, the rents projecting going forward could go up 35, 45%. You know, we're just saying.
How shall I say? No comment.
Yeah, but you should see an uptick in a lot of loan applications for owner user scenarios. I believe so. You know, and construction also, like how you were saying that you're building out, you know, over by Camarillo. I think that place is prime for development right now, long overdue.
Yeah.
And, you know, I think you're going to see a lot of these kind of scenarios.
Yeah. Yeah. I'm gonna just show one last thing. Oh, I recently cleaned up my I wanted to show a loan scenario. Let me show one thing here real quick. Purchase loan proposal here. So when it comes to a financing scenario, are we okay on time, Meny? Another minute or?
Yeah.
All right, so this is what I call just a basic one-page PDF loan scenario. I just created one for an $8 million project, so I'll just leave this numbers up here. If you ever need this for any of your listings or you want to show a buyer what the landscape looks like, just email me the price to plug in right here, and I'll send a one-page PDF. You know, you got the 50, 40, 10 structure, the loan amounts, the interest rates. I always quote top tier pricing when I estimate a first mortgage, because there's more top tier customers out there than middle or lower. And I don't want to scare the top tier customers away. So you can probably get a 25-year fixed on the first for about 4.9, maybe less if they have good relationship with the bank. I'm at 4.97 fixed for 25 years. That's the payment. And, you know, if it was a special purpose property, it'd be 50, 35, 15. So we just do that. If somebody wants to put 20% down because they want their payment lower, then we'll probably do 40, 40, 20. It'll look like that. So there's several ways to skin the cat based on the deal metrics or the client preference. But 90% of the deals are done like this, 50, 40, 10. And you can text me or email me or call me with just the price to plug in here. And I'll send you over this as a one-page PDF. This stuff here on the right isn't there when I send over the one-page PDF. It's just this stuff here on the left. So don't worry about that noise over here. This is our internal Excel tool that we used, and then I convert it to a PDF. It doesn't have this nonsense on the right. So these are good to put with your OM or your online listings. Sometimes the brokers teams or staff will put the KW logo right here, so it's co-branded or what have you, and you can remove my name and email if you want, so people don't call me, they only call you. You know, we can customize it to your preference. So let me know if anybody wants any of these for their owner user listings, and I'll be happy to send that over. But generally speaking, the lenders are lending. You know, a lot of the banks shut down during COVID because they had to do all the PPP. All of that stuff's behind us, so don't be discouraged about that old news that was 2 years ago. The lenders are lending, SBA's lending. You know, don't let any noise about lenders tightening up this or that get in the way of you and your customer doing a deal, because there's plenty of capital sources out there for these first and second mortgages. So just keep that in mind.
I think Shitra, I don't know if you're on the call, if you can hear, but I think that Lee can be a great resource for a lot of the connections you have.
Thank you, Meny. I'm taking it all in, and Lee, I will be in touch with you.
Sure. Who was speaking, if you don't mind? I'm sorry.
This is Chitra.
Hi, nice to meet you.
Chitra, and feel free. I put Lee's information on the on the chat, so get his information, reach out, and you can put your cell phone and email. Lee can reach out to you directly. And Michael, we definitely look like twins, so it's easy to get confused between the two of us.
I think I can see that you know we get the looks, you know. Well, I think Chitra, you can use this for the hotels. I think it could be very good for some of the hotel things that you have going.
Yeah, I still have that hotel in Arizona, but it's just sitting there.
Mm-hmm. Mm-hmm.
So,
could
you know,
be-
we do hospitality.
Yeah, that's what I'm thinking. Like Lee, you could be helpful in giving a few debt quotes when it comes to either an acquisition or a refi. One of the two, I think it could be beneficial for her.
Yeah, I mean, on a refi, there's no injection required. The equity in the property is the injection. So like on a refi, it would be a 50% first, oh, sorry. It would be a 50% first and a 50% second. So there's no injection.
Right.
And the refis go up to 90%. So if you have a highly leveraged property and the conventional lenders won't go past 75 LTV, on a refi, the government 504 program can go to 90% LTV. If there's cash out, which is allowed, the LTV gets reduced to 85 on the refi.
Are we
Could be
restricted?
interesting.
Are we restricted to California, or we're talking about all over the US?
California, Arizona, Nevada are no-brainers for us. If it's a different state, I guess the best thing to say is case by case. But more often than not, I'm able to do other out-of-state deals as well. So kindly run it by me and then we'll go from there. Absolutely.
Great. Thank you, Lee.
Sure, my pleasure.
Thank you, Chitra. And Lee, she put her info in the chat. You can reach out to her afterwards. Lee Kleinman, BFC Financial. Awesome things as always. And whatever you want to share with us and to Kim, and she's going to e-blast with the recordings later on. Thanks, Lee. Welcome to stay with us for the next few minutes. Anybody want to pitch?
There's one more thing I would pop in. Juan, are you there?
Yeah.
Yeah, he's here. Yeah, Juan is there.
Yeah, I'm here.
One.
Juan, I think with a lot of the Bakersfield development opportunities that you and the team have going, it could be useful to just get some of the, 2 cents from Lee. Just because I think, having that kind of options on the development side of the table over there could be very helpful going forward.
Yeah, no, most definitely. Thanks for bringing that up. As you were talking, I was just usually I like to talk too much, so I'm learning to be a better listener, because I'm always talking. But most definitely, we have a property right now that comes to mind. It's a 9 acres SD2 zoning, which is a very unique zoning. I have meetings with the assistant manager there in Tehachapi, and it's a development play here, but yeah.
Got it.
It would be good to get some debt quotes from Lee, I think, just to have them ready for anybody that you talk to.
I was literally emailing you.
Yeah. So, yeah, land with development. Well, maybe the developer's going to develop the units with their construction loan, and then they're going to sell off the units as owner user units.
What was that? Are you asking me?
Is the landowner going to develop them into multiple units and then sell them off to owner users?
Well, this particular land, I mean, it's a very nice piece of where it's located. I talked to the assistant manager, and they would rezone the land because it's a pretty unique zoning and rare zoning. And during my calls, at least what I got from the people that own units in that area, which that's a hard part of our job, getting a hold of the decision maker. But the ones that I didn't get a hold of, it was they're kind of like on pause, and the ones that I talked to, which was like 3 of them, they weren't doing ground ups, like that particular group.
Got it. Okay.
But I'm sure, like anything else, I'm sure there's somebody for it.
Yeah, I mean, if someone owns land and you know, I'm not sure of this exact scenario, but many times an investor will own land, they'll hire a contractor to develop into multiple units, and then the owner will sell off the units to different owner users. You know, I see that a lot. But on the land topic, if you have a business that needs a piece of land to park trucks or for storage, and there's no structure on the site at all, and they're going to use that land for 51% or more owner occupancy, land by itself with my SBA 504 program is still 90% financing. So I've done 90% land deals for business owners where there was no structure. It could have been paved, it could have been raw dirt, could have been fenced and lighted, it could have been no fence and lighted or lighting, but just land by itself for owner occupancy use, 51% or more is 90% financing. Because the bank is at 50, right? So they're at their typical 50% for a land deal. If it's just like a conventional loan going to a bank, they want to be at 50. Well, on a 504, they're at 50 at their comfort level with 50% LTV on the first, and the government's okay coming in with 40% on the second on a just a piece of land. So thought that was worth mentioning.
And you know,
Any kind of debt quotes, I think you can give him is just additional ammunition that he can use.
Oh, then lastly, things keep coming to my mind. We have 90% financing signs that I don't need to show them, but they're either wood post signs or they're banners that go on a fence or a banner that goes on a wall or a little sign that goes on the inside of a building window. But you know, it just says Business Finance Capital, Lee Kleinman, 90% financing. So it helps advertise to the public that a buyer can buy this property with 10% down. Because believe it or not, some people don't know that you can buy commercial with 10% down, even though these programs have been around for 40, 50, 60 years. So just a little marketing spiff to help get the word out. So if anybody needs a sign at an owner user listing, we can have that installed for you.
I think it's very smart PR. Again, feel free to share one image with Kim so we can share with the group, because
Yeah,
if I had a property, it's got to be also like, you know, the right property to advertise that. But I would definitely put one of those signs up, because that's gonna get people to call me, right? And ask me about what is this, and I can capture, or you know, call you directly and you can ask him, you know, where do you see the sign, etc. But that can capture more principals or buyers,
correct.
you know, for that. And whoever's on the call, right? Right now, we're gonna watch the recordings. If you have any kind of question, like you're not sure if that can qualify, that type of property, buyers, etc., reach out to Lee, right? Direct number is 818-438-0828, or Lee at bfcfunding.com, and ask him to run the scenario for you guys and partner up with the best out there. Okay.
Thank you.
Awesome stuff, Lee. I appreciate that.
Sure.
Thanks, everybody. Anything else? Any other last questions anybody has? Okay. Well, thanks, everybody. Thanks for being here. And I'm going to see you in, Kim, when is the next meeting? I think in 2 weeks from now. So it's going to be the
20th.
The 20th. Do we know
Yeah.
who the guest speaker is going to be, or?
It is potentially the Air CRE.
Oh yeah, Air CRE. Yep. Yeah. We're going to have those guys jump on the call and share some tools and insight. So very cool.